the role of international equities in portfolio management. And I'll welcome the host for this, Andy Gardner from Fiera Capital.
Hi everyone, so I'm Andy Gardner, Portfolio Manager for Fiera Atlas Global Companies Fund, and appreciate you all sitting around for the last session of the day, so I'll try and make it a good one. I don't want to get between yourselves and the bar. And perhaps the fact that the growth or the equity manager has been given the graveyard slot at the conference is a sign of how much sentiment has shifted in markets in the past 12 months. So if you're looking for a contrarian buy signal, that's all you need to know. Now, on a serious note, obviously I'm going to address some of the IMAP challenges. You've been here all day, and I assume all of you have got equity exposure one way or another because it's not a niche asset class. And so rather than dwell too much on macro, because of course there's a laundry list of things that we'll talk about, but effectively, I'll rather focus on the approaches that you can take within equities to deal with macroeconomic issues. And really where I'd like to get to, because equities are a long-term asset class, that it's really about the long-term drivers of what drives returns within equities, and that is the fundamentals. And we've had so much focus on macro factors and so forth in the past couple of years particularly. I really do believe that we're going to get back to fundamentals fairly shortly. And it's not that fundamentals have ever gone away, it's just they've always been there. They kind of get pushed aside occasionally. And given that you're building portfolios, and this is a portfolio construction forum, it's a good reminder that fundamentals really do explain long-term total returns and long-term risk. So let's get straight into it. Sorry, that was my overview. So this kind of sets the scene. So yeah, as I mentioned, if you look at the laundry list of threats on the left-hand side of the page, you probably do well just to leave the house, let alone manage money. And the truth is that macro issues forever occupy investors' attention. Go back 15, 20 years, you had the financial crisis, then it was the European sovereign debt crisis, and it was Brexit and so forth. And really, I think there are two main approaches you can take within equities to deal with macro issues. One is to sort of be very good at building or changing your portfolio in anticipation of that macro event. Now, in order to be able to be skillful at doing that, firstly, you've got to be able to predict the macro event in the first place. Secondly is time it. And thirdly, recognize that asset prices often sort of react in very surprising ways. If I'd got on this stage just a few years ago and told you that oil prices and bond yields would go negative, I think the vast majority of you would say that was probably impossible, not just unlikely. And even if I could convince a cohort of you that that's a scenario that you need to plan for or build your portfolios around, I think quite reasonably you'd be expecting that the economic situation must be so dire for bond yields and oil prices to go negative that equities must surely also be crashing. But of course they were also rallying at the time. And then there's the factor, the reasons behind that is stimulus, liquidity, and so forth. So it gets really complicated. So you probably guessed that that's not the approach that we take. And there is an alternative approach, and that's what I'd call like kind of the fundamental approach. And that really requires us to be able to assume that uncertainty is the norm rather than the exception. And so how we do that within equities is to focus on building a sustainable portfolio of cash flows that can withstand the vast majority of economic shocks, because you never know ahead of time what the next shock is going to be. Now, I'm sure at an allocator level it might be a little bit different to what we do at a manager level, but ultimately the steps are probably somewhere broadly similar in the sense of, very briefly, how we would look at this fundamental approach is, number one, invest in what we would call exceptional companies. Those are ones that can be relied upon to increase intrinsic value year in, year out, persistently and consistently for a long period of time. Secondly is make sure that you don't dilute the benefits of that cash flow compounding machine by overpaying. So you need to be able to deliver good value from the portfolio over your time frame, which for us is 5 years. Thirdly is ensure the portfolio is diversified. So as long-term investors, we think a lot about where cash flows are derived from and how correlated those cash flows are. And then fourthly is to invest for the long term. Equities are an investment, a long-term asset class. And really that's where the that's where the skill or edge can be deployed if you're a fundamental investor. And so we'll think longer than the marginal buyer in the average holding period. Now, if you're successful, I guess, at delivering on all four of those steps, then by definition, should be on track to deliver the objectives. And everyone's got very similar objectives. And again, we've talked in numerous forums this afternoon around return and risk. So the first one being strong capital growth over a full investment cycle. And for us, that means for equities, I think you can deliver very much a double-digit return. And we'll talk about that and how we can stand behind sort of that bold statement, even in this current macro environment, because I think it's important to do some scenario testing around that, which we'll do later on. And then secondly is to protect capital through a full investment cycle. But what we're focusing on there really is to that once-in-a-cycle event where earnings are going to go and contract, and that's possibly the most painful period for investors. Now, we've not seen one of these for a while, but if you reflect on the 1991, the 2001, and GFC periods, earnings contracted between 35 and 60%. Now, that's not necessarily our forecast going forward. One, we don't forecast, but two, it's not necessarily what we're thinking about the current market environment. But the message I want to convey is that up until this point, the market downturn that we've had in the past 12 months has been really one characterized by price or valuation compression. I think that we're now moving into a question mark over the earnings resilience and even softer macroeconomic environment, how resilient those earnings are that you own and what kind of exposure you want during that environment. So in order to do that, I'm just going to present this framework. And ultimately, total returns can be broken down into two key building blocks. One is that price or valuation I've talked to, and the second is earnings or fundamentals. Now, there's huge amounts of empirical evidence that will show you that the longer term you invest, the more important the fundamentals become as a component of your total return. So over a 10-year period, between 80 and 110% of your total return could be explained by fundamentals. And even over a 5-year period, it could be between 70 and 80%. And so that's not to say that valuation isn't important. Valuation obviously dominates the short term and contributes to the long term. The point is that for us to be able to deliver good total returns to our clients and your clients, we really need to be getting those big fundamental bets right. And so the chart on the left-hand side here shows you that our lived experience in the past 5.5 years does align to that empirical evidence. So if you look at the left-hand side of the chart, it's breaking down those total returns into valuation and fundamentals. So as you can see, over 5.5 years, the vast majority of that 20% annualized total return has been explained by the fundamentals and the compounding up. And those fundamentals have grown at around 15% per annum versus the MSCI World, which is giving you 10%. Now think about that 10% because typically MSCI World actually delivers you about 6 to 7% earnings growth and a little bit of dividend. So it's a little bit higher than normal, and that's because we've been at a cyclical peak. We haven't yet seen the earnings downturn, but also we've seen the energy earnings, which are up 5-fold from almost nowhere. So I'm not sure if necessarily that 10% is repeatable or sustainable for a long period of time. But nonetheless, I guess we would at least stand behind that 500 basis points of what we would call sort of structural alpha. That's the fundamental spread that we're continuing to try and harvest every year. The reason why this chart's also quite useful is explaining the past 2 years. Now, there's no getting away from the fact that valuations have had a major impact on markets. So if you'd looked at this chart towards the back end of last year, our total annualized returns from our portfolio were about 30% or just over. And with over 10%, nearly 15% contribution from valuation. And that's all come crunching back in. Same with the MSCI World. 1 point post-COVID is about a plus 700 or 800 basis point contribution from valuation. Now it's showing you minus 1%. So you've seen this big valuation compression. That's what's happened. That's told you the story through the past 2 years and why total returns in equities have fallen quite sharply. Now looking to the earnings resilience phase, which I think is where we're going to increasingly focus our attention. And this chart on the right-hand side shows you that fundamental building block, or earnings, expressed as a time series. And the gap there, which is the 15% compounding up versus the 10%, obviously will grow over time. But really, it's the stability and resilience of the earnings that are in focus here. And if you look at that red shaded area, that was the initial onset of the COVID period, when, of course, if you remember, the world literally stopped. We were in an earning contractionary phase. And during then, the portfolio earnings were revised down by analyst estimates for our portfolio by 11% and 22% for the MSCI World. So ultimately, that's the framework of the philosophy and this fundamental approach in action. 50% higher rates of compounding up of fundamentals for 50% lower drawdown in those fundamentals. Now, I've set the scene and applied it to things that I know, but whilst I'm not a market strategist, you can apply this framework to anything that you might think about, whether it be geography, sectors, or styles. So where this is about geographies, and where this came about was we had a client that said, look, you guys have got a lot of US exposure in your portfolio. Why is it that the US market has outperformed emerging markets by so much in the past decade? And you can see here in the white line, which is price, the US market in total is up 190% in the past 10 years versus emerging markets, which are flat. And the underlying subtext really was that he was insinuating it's all styles, factors, and valuation. And we wanted to provide a bit of a fundamental input to the debate or discussion. And you can see here that in blue, which is the earnings, US earnings are up about 112% in the past 10 years, whereas emerging market earnings are down. They've gone negative. So you've gone backwards in emerging market earnings. And so the vast majority, over 2/3 of that price outperformance has been explained by the fundamentals. There has been some valuation, but fundamentals have underpinned a large portion of the reason why the US market has outperformed. So whilst most people focus on price relative, some will talk about earnings, how much earnings support the price. What's really interesting and very few people talk about is the structural underpinnings to why earnings outperform. And in the US, those companies have generated a 200 to 300 basis point higher return on invested capital each and every year for the past 10 years. It's been a consistent spread. So that's just a lot more compounding working for you each and every year in those companies in the US. Now, if we think, and also I should say maybe that there's also talking about that risk side of the equation. We're talking each slide here about return and risk. There's much more stability in the US market. If you look at emerging markets there, the blue line, it looks like riding the Big Dipper roller coaster. So hats off to any manager that's obviously kept their hair on during that period. But so if we look at factors, because it's very much in fashion, and we can control for the country factor, if you like, and look at value versus growth. It's a very similar story. We all know that growth has outperformed value quite considerably over the past 10 years, but the vast majority of that has been explained by superior compounding up of fundamentals. Now, what's really interesting here is that structural underpinning that I was talking about of returns is significantly higher. So growth companies have generated a return on invested capital between 800 and 1,000 basis points higher than value companies for over a decade. So as I was saying, that's a huge amount of compounding working for you each and every year. Now, obviously we've got a bias to this, but this gets to the heart of this value versus growth question, is that whilst I can completely see how these things can occur in the short term, given the mean reversion in multiples and valuation, and those extremities have to come in. But if you're thinking about a long-term bet between, say, 5, certainly 10 years and beyond, and if you were to believe that value is going to outperform growth over that period, you actually really need to believe that return on invested capital premium is going to almost switch and go the other way. And that, for us at least, is a little bit difficult to wrap our heads around, because whilst we hate the labels, ultimately, within the value cohort, you do have a higher proportion of highly levered, highly cyclical, low margin, relatively capital intensive businesses that operate within commoditized industries. It's just a fact that it's very difficult to deliver high and stable returns under those conditions. Now, of course, if you're also concerned about a slowing economic environment, do bear in mind that very small changes in unit demand can take you from just above cost of capital to just below quite quickly. And of course, if you are worried about higher levels of interest rates being sustained, then that will really impact you if you're a levered business or require lots of borrowing in order to fund capital. Now, I want to play devil's advocate, because actually, whilst there are problems being an active stock picker with just overall allocations to these buckets, and I've talked about some of the issues that you can get within value, it's the same with growth. And I think the past 2 years in the bond yield volatility has really lifted the hood on what it is even growth managers have in their portfolios. And the truth is that growth does not create value. Growth can also destroy value. And the point is that you need two things. You need an economic profit base, and then you need economic profit expansion. So it's not going to have one without the other. And as we've seen, I think it was mentioned in the previous session, there's been a lot of hyper-growth companies that effectively went up, in the case of, say, Peloton, 8 times and then fell 90%. Because for a lot of those companies, there wasn't the economic profit base. So we don't invest in the hyper-growth kind of companies. And I think it's really been a reality check for actually just thinking about key fundamentals again, and rather than getting wrapped up in thematics and all that kind of stuff, which is just another code word for growth. Growth is just one key component of delivering returns. So this bond yield volatility, which caused a lot of that valuation or exposed a lot of those multitude of sins, if you look at the long-term bond yield, so this is 10 years, because ultimately equities are a long-term asset class, so it's kind of a proxy for long-term discount rate. And we went from a pre-COVID peak of 3.3%, and we crashed all the way down to 0.5%. Now, one perspective you can take is you can express yields just like a multiple, because it's just 1 over the yield as a multiple. So it's a bit like saying that bond yields went from a PE of 30 times to 200 times. So obviously in hindsight and on reflection, it's no surprise that all asset classes, given opportunity costed capital, got re-rated as well. So equities here, S&P 500 went from 18 times to 28 times, housing, growth stocks, and everything. So one thing, though, I would say is that we've seen, if you look at this chart, that red period, we've seen some normalization. So I'm not trying to call a bottom by any means, but clearly a lot of that valuation excess has unwound. And that's why perhaps we can get back to some of the fundamentals. And because it has thrown up opportunities. That's always the case when you get risk-off environments and you get big sell-offs which are indiscriminate. These are just a couple of companies that we've owned for a long period of time, but are just examples because there's quite a lot of these across the market. And here is IDEX on the left-hand side. So it makes diagnostic equipment for veterinary practices. So we know that pet care is a big theme. We've got more people owning pets, spending more money on their pets. Pets are living longer. Pets need more care. IDEX has got significant competitive advantages in this respect. Accounts for over 80% of the industry R&D. Very high growth margins and returns. And this is a 20-year chart, so it's been compounding up for a long period of time. And if our framework or our basis of what I've been saying has any value, then you should see that prices should connect to earnings over that very long-term period. And here you can see that they are, but they also do disconnect, and that's the red shaded area there that I've tried to highlight. But what happens is you do get reconnection, and that's because ultimately share prices are like an elastic band. They can only stretch so far away from a fundamental reference point before snapping back. And it's a similar story with ANSYS on the right. So ANSYS is a company that makes simulation software. So if you think about it as like virtual prototyping for aerospace and automotive industries, ANSYS is a clear leader in that is the only company that can do really high performance simulation in prototyping of physical products. And it's the same story. There's a connection here over the long term, but there is also instances where you get disconnections. Now, I would point out, during the GFC period here, is the resilience of the earnings of both ANSYS and IDEX. And that's because ultimately they're delivering a lot of, and this is mentioning this because, of course, we're going into a period of concern over economic environments. And I think the ultimate defense of that is, are you delivering good value to your customer? So does your customer value the product greater than the price that they're paying for the product? And that's certainly the case for these two types of companies, which are mission critical and have got a high degree of recurring revenue behind them. And I do think that would continue to be the case should we enter a slower economic environment. And that brings me to the last slide, which I'll conclude. But ultimately, again, I wanted to use this as a framework for you to think about long-term total returns in equities, is that you need to make an assumption of what your fundamental building block is, because it is the main dominant driver of your overall returns if you are investing for the long term. Here I've just chosen the 15% because that's what we've delivered historically, and everything at least that we do is geared towards continuing to deliver that return on invested capital premium. If you were delivering a 15% total return from the fundamentals, you could withstand a 20% further fall in valuation and still deliver double digits, so that 10% I mentioned earlier. You could, if you're worried about break-even returns, as in at what point do you start losing money over a 5-year period, you could see a 50% fall in valuation and get to 0%. Obviously, you can play around with that as you will. But also, that's the return side of it. I think the other key message, again, is just that fundamentals really are your first line of defense when times get tough. And if anything, when everything else is going against you, you really need them, if anything, to do even more of the heavy lifting. So I think I'll probably close it out there, and we can delve into any of those topics in Q&A.
Great, thank you. Can I just welcome up the panelists? So Alex Donald, moderator, Ironbark, and some very well-credentialed panelists, Alex Ventelon from Morgan Stanley, Daniel Stojanovski from Centrepoint Alliance, and John Wong. Is John here?
Oh, John's not here.
John's not making it up, unfortunately. And Alex, you're going to have to stick to time here.
I will. I hear you've got to go somewhere, have you?
I've got to
Have you? Oh, good man. Well, thanks, Andy. That was fantastic. And so we just wanted to pick up probably a couple of those points you made in the question to the panel, who sort of moving from fund manager to allocators, who have the joyous job of picking fund managers. But probably the first question is, to Andy's point about valuations versus fundamentals. Clearly, you've seen, some markets in correction territory, very heavily valuation driven, and I think there is an open concern about whether fundamentals and earnings are to follow. So the sort of opening question is, do you think valuations have fallen far enough? What are you thinking broadly about equity markets at the moment?
I think having a look at it from a sort of asset allocation level, from how you're putting portfolios together, I think if you're looking at the individual spaces right now, in looking at international equities, Have valuations got a lot left to sort of fall? Yes, there's probably a potential of that given the economic environment, but it really depends on the sector, depends on the different styles you're really accessing. So there's a range of sort of inputs there.
Yeah, I think clearly our view is that valuations haven't fallen enough. The issue that we have is mainly with the US market still trading in excess of 17 times next year's earnings. And so on the P ratio, we also think the E is overstated. So we're not going to get 7% EPS growth in the US. So the P ratio has to come down, but the E factor has to come down as well. So that's double negative for us. And so unfortunately, the march of market is such that the price will adjust first. Analyst revisions will come second. So that's why you have to position ahead of that, because again, revisions will come later.
So just specifically on that, we've obviously had a reasonably strong earnings season. You know, how are you positioned currently, and what would you see as changing in your portfolios to do with that?
Well, we've been quite notoriously defensive for a while. We believe we are in this situation where we had such strong tailwinds from a macro standpoint coming into this year that would take an enormous amount of tightening to really constrain monetary conditions to the point where it's hurtful, not only to the economy as a whole, but really to the unemployment side of things, which is usually the last thing that breaks. Right? So we are at a time when the very leading indicators are starting to roll over, but the lagging ones, i.e. companies' earnings on a 12-month basis, looking back, and employment are still quite strong, right? And we think that looking at past data is not going to help us, right? And if anything, the fact that the data is coming in quite strong gives plenty of room for the Fed to be more aggressive and actually dampens the economic activity even more than we think.
So Andy, when you're thinking about an environment like that, and you're very focused on cash flows and earnings and fundamentals, you know, how are you thinking about that in the portfolio at the moment?
Yeah, so I guess to follow up on the points, I mean, that's certainly what we're concerned about if we were to be concerned at a macro level. I mean, ultimately, every day what we're doing is assessing the individual companies and looking at whether they've got the resilient cash flows, the reason why they're in the portfolio in the first place. And I think we feel pretty comfortable. Yeah, they're all, no one's immune from, no company's immune from a slower economic environment. It's always just about the degree to which you're exposed. So we could, I do think I'd sympathize with the view that if you look, us not being a strategist, I get about 10 strategy emails a day from brokers and so forth, that clearly if we were to go through a prolonged period of a downturn, or if inflation were to maintain at a much higher level, in aggregate, the overall market still probably does have some valuation risk embedded in it for sure. There's no question about that. So look, we're just evaluating every company on an individual basis level. So what we will do is stress test cash flows. So we run a bull bear and a base case for every company that we invest in. We'll stress test multiples because it's a component of our total return expectations over our 5-year period. And then we'll take both of those into consideration. And if it were then to continue to be able to meet our hurdles, we'll continue to maintain the investment.
Great, thank you. And Alex, you mentioned monetary conditions, obviously, you know, policy and so on. You know, when you think of, obviously, the biggest backdrop for that is inflation. So how do you think about positioning portfolios in an inflationary environment? I mean, in a managed account sense, you've got unit trust products you can use, you know, but how do you think about constructing portfolios in that context?
Well, the trick about that...
Oh, sorry.
The trick about that is what part of the cycle we're in with regards to inflation, because the nature of inflation in a normal cycle, and that's pretty much what we think we are in right now, and probably the last 15 years, we're something that was an exception, and we are back to the old economy in terms of how the economic cycle works. And so you have this first bit of inflation coming in very often due to the supply mismatch, the mismatch between supply and demand. And that's where very often you have commodity prices going very strong. Of course, there's geopolitics on top of that. So it's the time when you want to be long as a hedge against that. You want to be long companies and sectors that would benefit from higher yields, whether it's on a nominal or real basis, and probably a lot of miners, energy producers, and banks, for instance. But very soon after that, the inflation overshoot forces the central bank to press on the brakes very hard, so that these industries that are cyclical by nature, you don't want to be in them anymore, right? And a good example is the banks at a sort of international equity level, right? And so even if there's still plenty of inflation, you're still gradually shifting away from those more cyclical inflation hedges and going back into companies and sectors. Maybe infra is actually a good sort of in between, a good transition area as the economy slows down.
Daniel?
I think probably looking at it from two sort of angles here. You have the strategic asset allocation that you would have as a basis to a portfolio. And then really what you're saying is, well, maybe that's your long-term basis. You're holding onto that basis, and that's how we're looking at it. But then the asset class within it, so you're looking at international equities, you're saying, well, maybe I'm making changes within the weights and the different styles we have within that. Because we all know from an inflation, for example, affects valuations. And then basically, essentially, you want companies that have stronger pricing power, because those companies will tend to last better, and obviously their future earnings are really counted. But then on top of that, the other scenario is, what if we have prolonged inflation? Well, that's a structural impact. And then we're just sort of looking at it and saying, well, what type of styles are we really allocating to within that? How best are we sort of providing sort of that exposure to value? How much risk are we taking, or to the growth side, etc. So it's that asset allocation within, and how much risk you want to take depending on the economic environment.
I mean, you mentioned, can you hear me okay? So you mentioned value growth, which is a sort of very well debated and discussed anomaly in markets, and about how we're rotating between one and the other. Is that the right way to look at portfolios at the moment? I mean, growth is a very broad church. It's in everything from ARC, highly speculative growth, all the way through to sort of probably the more quality growth of a Fiera. Is that the right way to think about it, or should we be thinking about things differently to that?
The way we've thought about it is, you have, okay, if you're considering that ARC, that go-go growth versus the quality growth, or probably if you have in a scenario like the 70s, you don't want to be in an ARC. So it's understanding that level. But value versus growth, our viewpoint has always been we want a neutrality between the both. And you can tilt between, and again, in managed accounts, you have the ability to probably tilt between one style versus the other, depending on maybe shorter term economic environments, not as an alpha generator, but as a risk control measure, more than anything, and understanding the process of the underlying manager and what they're trying to achieve. So really our approach has been, maybe we're not choosing one versus the other, because no one has the magic answer of what's going to happen going forward. I think that's the other aspect.
Does it make you at the margins sort of, pull away from the extremities of style? Yes.
In short, yes. But then you sort of need the different styles within a portfolio. You need to have both extremes, I think. And it's how much volatility in general you're willing to take. So how you're blending those extremes with other styles in your portfolio, or asset allocation within that space.
Alex, same question for you.
I would concur absolutely, and I think Andy, you made that point earlier on. I think it's really right now about quality, because of course, going back a few years ago, it was a relatively easy decision to make to be long growth, because growth was subpar and central bank balance sheet ever expanding. Right? And as we were about to reverse that into this year as well, that decision to go long value was relatively easy. Right now, where we are is that for the sort of deep value or sort of lower quality bucket to still outperform, you need help from the cycle. And that's not what we're getting, right? The cycle, the economic impulse is going to keep moderating. So the low quality end of the value bucket will likely underperform. And similarly, within growth, the low quality and the ones that depend too much on valuation expansion will underperform as well. So I think I agree. You want to be blend. You want to be in the middle. You want to have a blend of growth and value. But in both camp, really, you want to adjust for the intrinsic quality of the companies. And so probably right now, it's an easier job to do as a portfolio manager, able to do your stock picking, than in our job where you're only allocating between either funds or ETF, because to target those segments of the market is extremely granular.
I'd sympathise with that. I actually, I wouldn't like to say my job is easy by any means, but certainly I've had a lot of client discussions recently, and just sitting across the table and seeing how they're trying to think about making tactical decisions or trying to reallocate to these buckets. And I guess I just have to continually conduct the same philosophy and process day in, day out. So it is a bit easier for me. But I guess that's the interesting component, is that if you are towards the extremities, and that's how you build your portfolios over time, it's been interesting that you end up having to do much more changes if you end up, rather than just being somewhere, a bit closer to the middle.
Have you found with the growth sell-off that there's presenting a lot of opportunities for good quality growth companies?
Yeah, I mean, I gave a couple of examples on the screen there, and I do really think it comes down, obviously, to the individual company. We've, in general, I think, seen, obviously, the hypergrowth that's fallen completely out of bed, having it been gone up multiple X and then fallen down quite considerably. And I'm sure there are some opportunities in and amongst that, but as I say, it isn't necessarily where we would go, because for us, the underlying actual economic profit that is stable and resilient, and then being able to expand it over time, is what we're looking for. So it's not about trying to sift through the debris, if you like, for us. We've been allocating a little bit more to the actual names in the portfolio. We had some companies that were on the bench, which has been a great opportunity to allocate to things that, over the past 2 years, when multiples were going crazy post-COVID, are now at a much more attractive valuation. So generally, we've seen it more from the opportunity perspective. It was a bit similar to what happened in Q4 of 2018. If you remember, there was a big rotation there. It was a price-led risk-off environment. Again, it wasn't an earnings-led one at that point. And so we were able to add 2 new names to the portfolio that we'd had on our bench for quite some period of time. So you will tend to see more activity from us when you do have these big dislocations and rotations happening.
Just changing tack a bit, we'll probably come back to recessionary risk and so on in a minute, but just on the emerging markets, developed markets slides, Andy put up some great slides about, type of earnings growth and compounding earnings you can get from emerging markets versus, say, the US. Again, how's that sort of building into your portfolios? How are you looking at EM versus developed markets?
So EM for us there is a small discrete allocation to EM in international equities. Now we're relying on the manager making those decisions within that, and the process that we've obviously employed that manager to run, and what we sort of like. But I guess the conversation, and we've seen it with even other client portfolios that I've looked at and helped, has been you can approach it in 2 angles, and it's interesting because looking at Andy's slides is exactly what I was looking at yesterday, but also a chat with a colleague the other day, where if you're looking at it, you can have a discrete exposure, that's one aspect, or you can use it as part of maybe a broader strategy that maybe allows the manager to go into EM when it sees value and go out on the fundamentals of the underlying companies. Because remember, EM is discounted due to its governance. So there's a discount rate there because governance is really lacking in some of the countries, but also some of the companies that are being, and that's sort of, as a valuation, we've seen that over the last 15 years hasn't really been, compared to developed markets, probably what we were expecting.
Alex?
I'm with you 100% on the discount and valuation. Very often it's justified by lower return on equities as well. You can see that also, like European equities versus US equities, where you have this giant gap in terms of valuation. I think the more like the issues with structural reforms in a number of emerging markets makes it extremely painful. And also the range of stimulus, especially in China, that can be put in the system without pouring fuel on fire in terms of credit bubble is ever narrowing. So the sort of like EM boom that we had with the globalization, it's probably behind us. And as well, we're sort of inverting this globalization now. So it's the efficiency of company, the competitiveness, and the innovation side of things that's probably going to drive the next leg up. And I expect that it's going to be quite difficult for EM to see a lot of re-rating before we see the fundamental side of things improving, knowing that geopolitical issues remain looming in a number of geographical regions. And the last point as well is that a lot of EM companies do have a developed market peer that's doing the same thing, probably at a very satisfactory level. So the arbitrage opportunity, if they're not providing you with this sort of stellar growth of 20% plus, will rapidly shift in favor of DM, because the impact on the portfolio volatility is a lot more beneficial from a portfolio management standpoint.
And do you think about stocks the same way? See the similar risk between emerging markets, developed markets?
Yeah, so the interesting additional point I'd say is currency, so whereby we've looked at many, there's huge amounts of companies in emerging markets, much more than what you'd find in the MSCI world, because of course it captures what the MSCI deemed to be a part of that index, because there's many more companies outside of the index. But nonetheless, when we've looked into many different markets, a good example was a consumer staples company in India called Gardner, which is, it's very difficult to get good growth out of consumer staples these days. It's actually a bit of a quality trap in the main, because in the US and even in Europe, a lot of those companies that were once the preserve of good quality growth and high returns have no longer really got the growth, and those business models have been really impacted by the internet, and just competitive advantages have worn away. But when you look in emerging markets, you can still get good growth out of consumer staples. So for Gardner, which is one of those types of companies, the headline level of revenue growth looks great, it's 10%. Express it in US dollars over that 10 or 15 period, it's actually 4 or 5%. And so what ends up happening is that what is an in-country, effectively, inflation differential gets expressed or worn away through currency differential. And so if you're in a developed market and you're obviously going to eat your local currency returns, it can be a headwind. Now, having said that, and I mentioned that the University of Opportunities in emerging markets is opening up. In China, for example, I think it will continue to become a market that, whilst there's geopolitical issues, too big to ignore. There's 1,300 companies listed in China. There's only 900 listed in Europe, and there's only 1,500 or 1,600 in the US. So it is an enormous market, and we've only got, say, 2 or 3 holdings there within China at this point. And the one that we do have is a very domestic-focused company. You've got to really be on side with the geopolitics. In any country, I think it was a good point. Even in the US, the Department of Justice is investigating a whole heap of companies and household names right this minute. So anything could play out there. But in China, of course, the government can wield that power much more quickly and forcefully. And so there's certain areas and swathes of the economy that I think are really too risky. Some that we wouldn't philosophically go into anyway, like banks, real estate kind of companies, because that's just not the kind of investors we are. But I think you've got to be very wary of companies that have built competitive advantages through even like consumer data. Those kind of, if you're not in line with common prosperity and social cohesion, you're probably in trouble in China. So you've got to be very careful.
Does that, in your emerging market exposures, you still have China, or are you going are you sort of ex-China? Still investable in portfolios for you?
I can only say that it's an issue we are considering. Right now, to be frank, we have 0 direct exposure to emerging markets.
Yep.
So,
Daniel, something similar, or?
I think for us, it's diversification is key in this area. And really, we do have that discrete exposure to emerging markets, but allowing the manager to shift within that, I think, has been the key to it. And then in other portfolios, like for example, in a retirement basis, we don't have any emerging markets, for example, so the risk is completely taken out. So I think it does fundamentally, just essentially means what portfolio you have and what you've explained to clients is really where we've got exposures in emerging markets.
So just thinking more then about broader portfolio construction, focusing less on risk because there's lots of them. But if you think about, are there any new strategies you're looking at? You're now in a managed account environment, which is different to paper-based portfolios for implementation. Talk about being a bit more tactical. Are you looking at broader mandates with managers, or are you looking to include discrete allocations to certain things? We see a lot of demand for global small caps, for instance, which traditionally in paper-based portfolios was more difficult to time. So are you changing the way you construct portfolios to include other different strategies?
So I think it fundamentally goes down to for us, it's been always the philosophy. In the philosophy, there's obviously risk premia, certain investment styles linked to those risk premia. Small caps is one of them. If you've got it in Aussie, why can't you have it in international? Why shouldn't you have it in international? And then it goes one step further. What type of managers do we have out there available in the universe? And are we comfortable with their process? And do we know how they're expected to run going forward. And I think that's been the fundamental in terms of within portfolios, so how we've looked at it. So we've always had those discrete exposures because I think it makes sense. But it's more that philosophical sort of piece that we have with clients.
Do you take, again, we have these discussions with clients about variable beta, long short, lower net exposure, global equities. Does that come into there, or do you just sort of put that in alternatives? No,
that does sort of sit in. I think there needs to be if you've got exposures to small caps, for example, you need to have some type of risk control measures with variable beta type managers long short that sits within that discrete exposure within, let's say, international. And then you've got obviously growth, value, and the rest as encompassing. So that essentially creates that diversification within the sleeve, for us at least.
So the way we go about things is that we'll go as granular as basically where we have a view, right? So basically, small versus large, we have a view on small cap, so we'll have a separate asset allocation on small cap if we are positive on small cap, because we try to be cognizant of the impact that these sort of granular allocations might have at the portfolio level from a tracking error standpoint, right? So when you go hard, EM and your benchmark for international equities, as it is for most people, is the MSCI World. So it's enough benchmark allocation. So from the first percentage that you put into EM, it's a high tracking error contribution. So you got to be fairly confident in making that allocation and wearing that extra risk. So that's the first thing. We got to have a view on the asset class. Then we got to have a view on whether the environment is more conducive for active management versus passive investing, right? So we have our own framework for that. We look at a number of criteria, and we do then have a probability of managers outperforming in that context over the next 12 months. If it's an environment, some asset class, of course, are more suited for for active management, or some are not, but the environment matters as well. So that's really how we're going about things. And then the security selection itself is really about whether we just want the beta trade out of that, or whether it's sort of like, it's a cycle play, and we want to be in there from the start and really leave the manager plenty of time to realize the alpha on their security selection.
Great, thank you. Now I know we've got to sort of finish up soon. So are there any questions from the floor?
Yeah. Just actually to extend Alex's question to Daniel and the other Alex. Thematic ETFs have been released quite a lot recently, and I've seen some portfolios where you've got active managers combined with things like a battery ETF or climate or something like that. How do you, I don't know if you do that in your portfolios, but if you were doing it, how would you blend them?
I might start with this one because it's a great question, because remember, while we're using the thematic plays with the client, client comes and they're sort of saying, I have a specific objective, I really want this, or I want to have a little bit more of a tilt to a specific sort of area, whether that be battery play or whatever that might be. That makes sense. We see it as a satellite approach. You have your core part of the portfolio, but you have aspects of it within that portfolio that should be suited to a thematic play if that client requests it. Now, on the other flip side, you can use, and it can be sort of useful to use thematics for specific tilts if you can't get it from the other managers, whether they be active or not, or whether they be core holdings or not. And that's how that aspect should be approached. From our point of view, I think they do have a place to play in the portfolio, but at the end of the day, it really just depends on what you're trying to target and how much risk you're willing to take, but then specifically to that, what the client objective is and what the client is sort of requiring around that.
In our case, yeah, we are a bit more comfortable when things that are extremely thematic are sitting outside of our multi-asset SMAs. So we like the core satellite approach. We do the boring stuff, and we're happy to advise the client on the sort of more thematic side of things. Some clients want 100% of that, and that's very fine. But we think our job for us and the way we approach that is that the team manages those multi-asset SMAs, and we are the steady ones, right? And that's why these thematic instruments very often carry risk exposure in terms of style as well that can be quite extreme. And when the tide turns, can hit you pretty hard and turns out to be extremely correlated with other thematics that were labeled differently. Right, and that's something that bothers me as a PM.
Other questions? I have one which sort of extends from this issue, which is we're seeing, there was some discussion in the earlier session on alternatives about implementation mechanisms and the challenges of implementation. We spoke a moment ago about thematic ETFs. I'm interested in the sort of active managed product that's now coming to the ASX. This is what you'd broadly describe as active ETFs. And whether you see a place for your portfolio in, of that type of investment, or any sort of structural advantages of active listed pooled investments, or are they, sometimes useful if you like the particular vehicle, as opposed to the sort of standard unlisted managed fund?
I think with that question, so I think that there is a place for them to play, that's for sure. And given that, Australia probably, if you look at the rest of the world, it's been pretty a common sort of occurrence. If you look at the US and the amount of active sort of ETFs out there comparing to Australia, I think they play a sort of a part where, let's say you have an equity-like portfolio and it's a pure play, 25 stock equity portfolio that maybe you need to have an exposure to. Maybe the diversification within that isn't probably correct, given the skews that we have in Australian equities or the skews that you might have with international equities. You can use a lot of those active ETFs as that sort of diversifier in portfolios. So I've always seen it as that's a positive thing in that sort of environment than anything else. And then if you have portfolios that are essentially ETF based, well, you're getting a lot more exposure to managers that are active and blending it with your passive where possible.
Active ETF, clearly it carries some liquidity risk. We all know the limitations of platforms in terms of trading in and out of unlisted funds. Now we have an approach where, in the models that we manage that are purely passive, we like to really try to stay as passive as we can in those models and really capture targeted risk premia that have a reason in terms of opportunity from a pure macro and asset allocation standpoint. So to us, even though they are listed instruments, they're actually more suited to our sort of fund of fund type SMA.
Any more questions?
Toby, I might just add, we're talking about active ETFs, we're partnered with active managers. No, but the point is that the big advantage is it creates less friction for an investor to invest. They don't necessarily have to go through getting the wet signatures of a trustee to invest. And for a managed account, it's even more powerful in terms of real-time pricing. You don't have to wait for the end-of-day pricing to get the unit price, and that creates certainty.
This wasn't a segue to you, Vinny, but thanks for raising that.
So, yeah. Alex, Daniel, and Andy, thank you so much for your time on the last session here on international equities.
Pleasure. Thank you.
Thank you.
Thank you.